So let's finish our discussion of financial statements looking at cash flows. One of the older types of statements was something called the statement of sources and uses. And essentially, this analysis looks at line items and then classifies them as either being a source of cash or a use of cash. So in the end, if you add all of the sources and subtract all the uses, you should see what the difference in cash is. So did the cash increase or did the cash decrease? So if you look, like here is a balance sheet, if you will, and we can see here that if assets increase, right? So it was 977, it grew to 1282, so it increased 306. So if assets increase, that's a use of cash. If liabilities and stockholder equity increase, that's a use of cash, right? So again, excuse me, it's the other way around. If it decreases, right, it is a use of cash. So again, I always like to think about the just one way. If you know if something is a use, if it's not that, it's a source. So in this case, if assets go up, that is a use. If liabilities and shareholder equities go down, that is a use. So again, the basic analysis here is just for us to be able to see and recognize sources and uses. The challenge with this statement, though, and this actually came about in the, I want to say the early mid 90s, is that it doesn't adequately reflect cash flow. It doesn't reflect the decisions that managers make. So in the mid 90s, they came up with another statement that's referred to as the statement of cash flows. And essentially, this divides all cash transactions into three categories. And if you think about it, it's really what managers should be thinking about. Managers should be thinking about operations, right? Doing the business. They should be thinking about buying new assets, replacing old assets. That's investing. They should also be thinking about how are they going to finance the operations of the company. So there are three distinct decisions that they can make. So each one of these then gives us an idea of how well the company is doing. So in the end, we would have a net increase or decrease in cash would then be applied to the cash balance from the previous year. That should tell us how much money is currently in the bank. So we have a definition of something called free cash flow. Essentially, we add depreciation and amortization to net income. That gives us free cash flow from operations. We then subtract the estimated expenditures for, they refer to capital expenditures, but frequently we also even include short-term kinds of expenditures. That gives us free cash flow. Now, this definition, this is not necessarily in our textbooks. It's the cash that's remaining after all the expenses of running the business, all the activities of short-term money management, and long-term asset management have been accounted for. This is the money thus left over to pay investors. So let's think about who are the investors of the company. Well, there are actually two. We automatically think of shareholders as being investors, but we rarely think that creditors are investors. But the only difference between the two are the obligations that we have to the two. So this is money that's left over to pay interest to our creditors and or buy back our debt. And it's money that's left over to either pay dividends or buy back stock. So those creditors and our investors, our owners, are absolutely interested in this free cash flow concept. So again, the statement, right? Here's the question. It's possible for a company to have healthy profits but not have enough cash, right? Positive net income, right? It's only important if the company can convert that income into cash. It's kind of a strange concept, I guess. Most of us are brought up thinking that profit is what businesses are all about. In the end, though, the thing that they want to create is cash, because you cannot spend profit. You can only spend cash. So how do we analyze these statements? What does it tell us? We can find out about their ability to generate cash flows, right? You know, what's their operations like? Can they make money doing business the way they're doing business, right? Do you think they'll be able to meet future obligations? What about external financing? Are we going to need some of that, right? What is the productivity of investing assets, right? How effective, how efficient are the operations of the company in producing cash flow? And finally, really gives us a highlight, if you will, of the solvency of the firm. So in the end, right, it's possible for a firm to be highly profitable, not be able to pay dividends, not be able to buy new equipment, not be able to service debt, and actually to go bankrupt. What is the problem? And obviously, I think the problem is cash. Understanding cash flow is important. So cash flow from operations is why we're in business, right? So if you had a pizza shop and at the end of the year, you found out that the profits from making pizzas was negative, what does that tell you? Either you're selling them way too cheap or you're very ineffective in producing the product, right? So this is a number that's very, very important. Now, if from time to time we have some shortfalls of cash here, we can borrow a little bit, but in the end, we have to be able to show that we can generate cash from running our business. So in the end, what is our final concern, right? The success or failure of the firm relies on generating cash from operations, right? We need to identify what the underlying causes of positive or negative operating cash flows are, right? We need to figure out what we're doing wrong, but we also have to know what we're doing right so we can continue to do it right. We need to know something about magnitude and the variability of cash flows over time. This is a key metric in understanding how efficient a company is actually working. So which is the better measure of performance? Is it net income, which includes some estimates, allocations, approximations? Not that those are bad, but they're not real. Or is it cash flow? Because cash is actually cash. So low or negative cash flow does not necessarily imply poor performance. You could be doing a really good job, you're just not producing enough cash. You need to figure out how to fix that. So here's an example of Hasbro's cash flow statement. We see here, 775, I guess this is probably in millions, million was in net cash from operations. That's a positive number. That's good. From investing activities, they spent $138 million. So it looks like they bought capital equipment for $155 million, but they sold other investing activities. So they sold some assets for $17 million. So it netted $138. Now, the cash from financing activities, again, it's a negative $331. So more went out the door than came in the door. So how did that happen? Proceeds from stock option transactions. So we had more cash come in from stock options. That's okay. But the proceeds from stock options went out. So we paid out some money to stock option transactions. We repurchased some stock, right? So that, again, that's money going out the door. Dividends paid. Oh, I'm sorry. So 42 for this. So I'm sorry. Proceeds from stock transactions. I'm looking here is 42. We repurchased common stock 249. Dividends paid was 249, right? So we net proceeds from short-term borrowing, more money came in than went out, and then there's other financing activities, another 17. So the net effect was more money went out the door than came in the door. Now net, we ended up with a net increase or decrease of cash of $306 million. So then our total cash at the end of the year, $1.28 million. So again, that's kind of a long ways to talk about this, but the idea here is there are three kinds of decisions we make. We need to make sure that this one is always positive. This number can turn negative from time to time, this 306. It's not uncommon to have total negative cash flow at the end of a year. Now, we can't do that year after year after year after year, but from time to time, depending on expansions, right? Depending on how we finance things, maybe by paying back debt early, it could turn out to be negative from time to time. So let's finish up our discussion of financial statements here with a couple other items. So the first thing we want to talk about here is market value versus book value. Now, financial statements are typically a mixture of historical and mark-to-market amounts. So book values are historical, and obviously market values are forward-looking. So the very few line items, though, are actually market values. Intangible assets that don't appear in financial statements, there's lots of them. Patents, brand reputation, human capital, right? Those assets have no price tags, right? So book values are historical. Market values are forward-looking, right? But intangible assets, a lot of the assets the company has are not things that actually have price tags. So what happens when the stock market crashes? Fair value accounting requires companies to record this, right? So we have to account for when prices change dramatically. Most small companies don't need to worry about this too much. The bigger the company, the more concern there is with fair value accounting. Most accounting is historical based, though. So how do you find the market value of equity? Well, if we look at Hasbro, right, the book value of their equity is $1.863 million. How do we find that? You take assets minus liabilities. That gives you the book value of equity. So what's the market value? The price was $77.79. They have 1.24 million shares. That is their book value or their market value, which is roughly 9.6 million or $9,685 million, right? So we're talking about $1 billion in or $9 billion in market value. So which one's better, right? I mean, it depends on the use, right? Depends on what you're using it for. We would expect if managers are doing good things for the company, historical value, again, doesn't change. It's historical. So the company should always have greater market value than book value. Market value is a measure of the wealth of the company and therefore the wealth of owners. Just a couple other things. The concept of goodwill. Goodwill is an intangible that's on the balance sheet. We've talked about this in a previous video, but it's the difference between the acquisition price and the fair value of the asset. So again, fair value is either the book value or the replacement value, whichever is more appropriate, right? So typically, you look at the replacement value of the assets. Goodwill minus the replacement value, the purchase price minus the replacement value is goodwill. So how important is that? If we go back and we look at a previous, I think it's the balance sheet. Let me try to see if I can't find it right now. But we would see that obviously the goodwill is a part, certainly I don't want to say an insignificant part of the assets of Hasbro. So let's think now about the difference between economic income and accounting income. This is the difference between realized and unrealized income. If marketable securities are marked to market, but no others, right? So these are those short-term securities that from time to time we find out what the price is and we update the statements. So the costs, the economic income recognizes the cost of equity as well as the cost of debt, and accounting income doesn't. So what does this mean? Well, there are some techniques, and we'll talk about a few of them later on, that measure economic income. Economic income, it's kind of a theoretical concept, right? I mean, in theory, that's the income. You want to be able to produce economic income. Accounting income does not look at some of these other costs that quite frankly are dependent on the marketplace. So as we go through some of these later videos, hopefully this concept of economic income and accounting income, hopefully it will become clear as we go through some later videos. That's the end of this video. Hope to see you guys soon. Bye-bye.